Every dollar in your traditional 401k is a ticking tax time bomb. You spent decades funding it, thinking you were buying financial freedom. Wrong. You were just building a deferred bank account for the IRS. Because the moment you turn 73, the rules completely change. The government forces you to start draining your own account, whether you actually need the money or not. And if you refuse, or just make a simple math error, they will immediately shred your wealth with a brutal 25% penalty. The system is mathematically rigged against the diligent saver. But there is a brief window to legally disarm this trap before it detonates. Let's run the numbers. Now, I know exactly what you are thinking. You played by the rules. For 30 or 40 years, you woke up, went to work, and diligently pumped money into that retirement account because every financial advisor told you it was the responsible thing to do. Take the tax break now, they said.
It is free money, they said. But here is the brutal truth they conveniently left out. They were setting you up. The IRS did not give you a tax break out of the goodness of their hearts. They gave you a tax delay. They let you grow that money tax-free when the balances were small, knowing full well they would force you to liquidate it when the balance was at its absolute peak. You are literally being punished for your own financial discipline. I am going to show you the exact math on how these forced withdrawals operate and how that 25% penalty can wipe out years of your hard work in a single strike. But before we get into those numbers, you have to understand the invisible tax that triggers automatically the second you are forced to take that money out. This is the part that Wall Street hopes you never figure out. This invisible tax starts with a government mandate, the required minimum distribution.
Under the SECR Secure Act 2.0, the magic number is now 73. Once you hit that age, the IRS legally forces you to start pulling money out of your traditional 401k. It does not matter if you are still working. It does not matter if the stock market is crashing and you want to leave your portfolio alone to recover. You pull that money out, or else. And what exactly is the or else? It is a brutal 25% excise tax penalty on whatever amount you failed to withdraw. You miscalculate a single form, and the government instantly confiscates a quarter of your required money. Poof, gone. But it gets much worse, because every single penny you are forced to withdraw does not get that favorable low long-term capital gains tax rate. No, it is taxed as ordinary income. The IRS treats your decades of life savings exactly like a paycheck, taxing it at the absolute highest possible rates. This creates a devastating domino effect.
These forced withdrawals artificially inflate your income on paper. And in 2026, if your inflated income gets pushed over $109,000 as a single filer or $218,000 for a married couple, you trigger a hidden landmine called IRMA. This is a Medicare surcharge. Instantly, your Medicare Part B and Part D premiums skyrocket. You end up paying massive, unnecessary penalties for your basic health care simply because the government forced you to take your own money. The math is absolutely ruthless. But percentages are just numbers. Let's look at the real-world cash this burns. Meet David. David is 71 years old. He worked hard, lived below his means, and managed to build a traditional 401k balance of $1.5 million. He feels completely secure. He thinks he won the game. Dead wrong. Fast forward 2 years. David turns 73. The IRS comes knocking.
Because of the Secure Act 2.0, David is now legally required to take his first minimum distribution. For a balance that size, the government forces him to withdraw roughly $60,000 in that very first year. Does David actually need that money to buy groceries or pay his light bill? Absolutely not. He has Social Security and a modest pension covering his daily expenses. But the IRS does not care. You pull it, you pay. That $60,000 gets slapped right on top of his other income. It is taxed as ordinary income, pushing David into a substantially higher tax bracket. Instantly, up to 85% of his Social Security benefits become fully taxable. The tax torpedo just hit him broadside. But wait, it gets worse. Because David is married, this forced withdrawal violently shoves their combined income over that $218,000 threshold for the year 2026. Bam! The IRMA trap snaps shut.
Suddenly, David and his wife are hit with massive surcharges on their Medicare Part B and Part D premiums. They are literally paying thousands of dollars more out of pocket for the exact same health insurance they had last year. Why? Because they saved too much money. And if David passes away before emptying that account, he leaves a ticking tax bomb for his kids. His heirs are forced to drain every single dime of that account within 10 years, usually right during their peak earning years. The government ends up quietly confiscating a massive chunk of his legacy. The math is terrifying. But you are not completely powerless. There are precise legal strategies used by professionals to defuse this bomb before it destroys a retirement. It happens during a very specific period of time called the tax control window. And if you are in your 60s right now, the clock is ticking.
The gap between the day you retire and your 73rd birthday is what financial insiders call the tax control window. This is the most critical period of your financial life. During these years, your earned income usually drops, which means you temporarily fall into a lower tax bracket. But instead of just sitting on their hands and waiting for the IRS to strike at 73, wealthy retirees go on the offensive. The framework you need to understand revolves around strategic Roth conversions and bracket management. They intentionally shift money out of the traditional 401k and into tax-free accounts, slowly filling up their current low tax brackets every single year. They pay the taxes on their own terms, at a discount, systematically draining the traditional account before the government can force a massive, heavily taxed distribution. They are effectively diffusing the time bomb, dollar by dollar.
If this breakdown just saved you from a six-figure IRS headache, hit the subscribe button and like this video. Decent return on investment for your time today. My channel is dedicated to giving you the brutal math that Wall Street and the government intentionally hide from you. But simply knowing about this tax control window is only half the battle. If you try to execute these conversions blindly, you could accidentally push yourself right back into the exact Medicare penalty trap we just talked about. There is one final mathematical rule that makes this strategy work. The final rule is bracket precision. When executing these strategic conversions during the tax control window, wealthy retirees calculate their withdrawals right up to the edge of their current tax bracket, and not a single penny over the IRMA threshold. They are systematically bleeding the traditional account dry on their exact terms.
They pay the taxes at historically low rates today, so the IRS cannot force them to pay inflated rates at age 73. This locks in wealth, starves the government of that 25% penalty, and finally takes back control of the money. But protecting a 401k from the IRS is only the first step in this chess match. Because the exact moment you file for Social Security, the government has another hidden trap waiting that can legally tax up to 85% of your monthly benefits. I break down the exact math to avoid that specific tax torpedo in the video on your screen right now. Click it, and let's keep your money out of Washington's hands.